what should we do if we were to have prudent economics? We should keep rates high, attack inflation head on, but that would create a deep recession, in my view, with the carrying costs of debt, whether that's corporately, government, or personally. So really, what is the government going to do? In my view, they're going to take the easy way out like they have for the last 25 years. They'll cut rates. Who knows? Maybe they start money printing again, which is inevitable. But really, the this inflation issue in my mind will just continue to get larger and larger.
A lot of hard commodities have been rallying, gold and base metals in particular. We're going to be talking about both copper and gold today, the outlook, what the rally means for the global economy, what a continued sustained rally may mean for inflation, and ultimately, where are these prices headed? We'll be talking also about the mining sector with our next guest, Jon Deluce. He is the CEO of Abitibi Metals. Welcome to the show, Jon.
Thanks for having me, David.
So it's interesting how copper and gold have been moving in tandem over the last year and a half, and especially in the last couple of months. Now, they haven't always moved together with a strong correlation historically. Sometimes it happens, sometimes it doesn't. Copper, as you know, is a base metal. Some call it Dr. Copper, has a close correlation where predictive power of global economic growth, while gold is seen as a store of value and a monetary metal. It's interesting how these two have been moving together. Is there a broader narrative as to why a base metal and a monetary metal may be moving upwards together at the same time?
Yeah, well, it's a very unique time to be seeing that, as you mentioned. But I think the thing is, and the theme for me is the effect of monetary debasement and the amount of money printing that we've seen over the past few years, and the effects of 0% interest rates for such a long time. So I think that theme is what has set the overall case for gold and copper. But then you complement the specific demand case for each of the elements. And like, to summarize, gold being a store of value, it's been a sound currency for thousands of years with no counterparty risk. And that's getting more and more important in today's environment. And then on the copper side, the amount of the use case, decarbonization, with EV and the infrastructure growth, and the supply demand imbalances there. So I think it's really, in my view, we have the overall pressures of strong inflationary headwind, supported by the specific demand case for both metals, which I think is very significant at the moment.
Okay, we will talk about the specific demand cases for both individually. Broadly speaking, though, if the base metals do continue to grind higher, suppose they do, or even if copper just stays elevated at current prices, above 450 a pound, what does this mean for inflation?
Well, I think inflation is here to stay. I think that when you look at real inflation, which I think is, you talk to anyone in the community, your friends and family, and there's a disconnect between published inflation and real inflation. I think the gap is growing on that metric. So I think in terms of real inflation getting down to the 2% Fed rate, I don't think there's any signs of slowing down on that mandate, especially with the Fed now commenting on a pivot in interest rate policy towards the end of the year. So I think that will fuel the next up leg and acceleration of inflation, because we need to take a step back and really, how have we gotten to where we are today? And it's the result of not accepting a recession, a large recession, for 25 years. We have pushed and inflated larger and larger asset classes and created bubbles. And we're now landing on the biggest possible bubble in the debt market and treasuries. And when you look at the cost of maintaining the debt, in 2025, the interest costs on the debt will exceed the defense budget in the US. It's very, very significant. So really, the Fed and where we're at today is we have a choice. Are we going to accept high inflation or a deep recession? And what I mean by that is, in terms of high inflation, the Fed's looking to cut rates, and they're having to do that because the carrying amounts of the debt. But what should we do if we were to have prudent economics? We should keep rates high, attack inflation head on, but that would create a deep recession, in my view, with the carrying costs of debt, whether that's corporately, government, or personally. So really, what is the government going to do? In my view, they're going to take the easy way out like they have for the last 25 years. They'll cut rates. Who knows? Maybe they start money printing again, which is inevitable. But really, the this inflation issue in my mind will just continue to get larger and larger. But at the end of the day, gold has been a monetary store of value forever. And I think it's why that gold and commodities will shine in this market. But to wrap that up, I think inflation is here to stay.
Okay, so you think that it's more likely that the Fed will sacrifice the economy to combat inflation? That's your view. What would that mean for gold then if let's say we have no recession but higher inflation, even from today's levels?
Well, I think that allows the cost of government debt to be less. That allows them to support election mandates and objectives. But gold in that environment, I think, will be very explosive. We are at the cusp of why in my view, people should be investing in gold. It is to mitigate the misallocation of currencies and the amount of what I would think is abuse that we've seen through money printing, through pushing the can down the road, is all coming to a conclusion right now. And I think people are realizing that. And we're going from an over leveraged and high inflationary environment, and people are rotating back to true stores of value. And I think that's where gold will continue to do very well and we have thousands of years of history to support that being the case. So really, I think the drivers of gold and how it will perform in this environment is obviously monetary debasement, and there being no counterparty risk with gold. I think you have to look at the BRICS countries. The BRICS countries have been stockpiling gold at record amounts, and it's rumored that gold could be a part of a new currency that's brought out by the BRICS nations. It's hard to see, but there's a reason why they're stockpiling gold. And now we're starting to see just the very start of the average individual starting to purchase gold, as we've seen large sales at places like Costco. So it's good to see that people are starting to recognize the need again for gold. I do think we're still in the very early stages, and I think that's very exciting from my standpoint as an investor to be this early on a trade that I think is going to be very important.
Gold's already run up more than 10% on the year, currently at 23.40 as we speak on the 23rd of April. You don't think that the price has already factored in this narrative of higher inflation that you're talking about?
Well, I think we've now broken two new all-time highs. I think we look at Goldman at 2,700 by end of the year, Citibank at 3,000. We look at individuals like Pierre Lassonde that are looking at 10,000 plus dollar per ounce gold at some point. I think taking a step back, we look at a similar environment in the 70s, and in a highly inflationary environment where gold went from $35 an ounce up to 850, around 25 times value increase. And when we look at that, I think that we could be at the very beginning of what is a very explosive gold market, because all of the factors, when you look at history and you look at the factors that have led to large moves in gold, I think that they're all here today. And I think it's still very under the radar, and people haven't yet recognized that. So I think sitting at $2,300 gold with the lack of attention that it's getting, the huge tailwinds that we have behind the value case for gold, and what we're seeing the East do in countries across the world, stockpiling gold, I think setting a clear message that there is risk in fiat currency right now. And how do people hedge against that? That's gold. So I think we could be at the very start of a large move here.
Copper as well. So let's move on to copper. The price of copper has got about 16% year to date. Now, as I said in the introduction, historically, people have viewed copper as a sort of barometer on the global growth aspect, or a barometer on just the health of the economy overall. It doesn't always happen that way, but just sometimes it does correlate with global growth. Right now, though, what is a 16% year to date growth on copper price? What is that signaling to you?
Well, I think it's a sign that we are starting to see I think it's a sign, it's an inflationary sign. I think it's also the supply demand imbalance that's just starting to show a small deficit this year and is looking to expand to quite a large deficit by 2030 with 4.7 million tons of copper and shortages by that point. I think it's signaling that the day of copper prices having to go up in response to inflationary pressures, the supply demand imbalance is here. So you look at Chile, for example. So Chile, one of the world's largest copper producing countries, is currently at a 25-year low in production. So we have supply weakening, but also demand accelerating. So over the next, up until 2030, we're going to see 35% growth in the demand side of the copper equation. So I think that 16% this year is a start. I think we're playing catch up with the pricing being behind the supply demand equation and the imbalances that we have today that are going to accelerate. So it's a very positive environment in my view for copper.
Okay, we're going to break down supply and demand. You brought up that there's a strong demand or future demand for copper. What is this case, John? What is this demand growth narrative that we're expecting here?
Yeah, so the demand is coming from various avenues. I think that it's clear now that our economy, individuals, everybody is very reliant on copper and the inputs that it has. But like looking at breaking it down, we require massive investment in power infrastructure upgrades over the foreseeable future. The U.S. just announced $3.5 billion in electric grid updates over the foreseeable future. The U.S. has also mandated massive investment in clean energy and the overall decarbonization movement. So, and that's here to stay. And you look at Shell did a study, and 80% of terminal energy is currently being is carbon based, and only 20% is based on electricity. So to meet our goals of decarbonization, there's a massive investment that needs to be made in distribution systems. And a lot of that requires copper. And you look at other uses like AI data centers. AI is the use and investment in AI is exploding. And the thing is the data centers that they need to create to facilitate that network require massive amounts of copper. So you look at and the EVs connected to the decarbonization movement and just general population and infrastructure growth. So really there's a big demand case for copper. And I think that with those factors and additional, that it will only continue to increase.
So can you highlight some specific industries that you think will have the most use case for copper? You mentioned infrastructure spending, so construction. What else can we expect, John?
Well, I think certainly construction, that's a big one. That is really supports a lot of the other initiatives. Like when you think about the EV mandates that we have coming up, people forget that you have all the infrastructure that goes into the condos and the houses to allow for these higher power charging stations. And a lot of that requires copper. So I think construction is a big and leading part of that demand, and how that filters through what I mentioned, the investments in EVs, the AI data centers, and just general infrastructure. So as you mentioned, I think construction is a big part of that.
Okay. Do you think that the supply shortage of copper can be rectified anytime soon? By soon, I mean within the next 5 to 10 years, whether it be from government initiatives to drill or explore more, or from the private sector?
I don't believe so. I think what's going to help with that mandate is higher copper prices, because higher copper prices will bring new mines online faster, will attract more capital to the business. But I think at today's prices, we are not going to have enough supply to meet the shortages by 2030. We're also combating the current production in terms of grade and production profile dropping off. So it's also the fact that the current production is slowing. Part of it is because of an underinvestment in exploration over the past 10 to 20 years with that filtering off compared to historically, and also a lack of new discoveries in the space. I think uh, the easy discoveries and easy mines have been found. So this all adds to the case for as of today with the factors that we have not being able to meet supply demands by 2030.
I'm just trying to understand how the supply equation could change if, let's say, today or tomorrow the price goes up by double. Let's just hypothetically assume
Yeah.
that. And then a lot of people are excited. We're going to get into the copper sector. How long would it take for a mine to be built and be online?
Well, it's a lot of time. Like the permitting process is it's very slow. This, you look at a tier one jurisdiction, and a lot of times it'll take 8 to 10 years by the time you make a decision to bring in a project online. So these are not things that even if pricing, even if copper pricing goes up tomorrow, it's not a quick fix unless there's reasons and we have more government support. And if copper becomes a strategic metal, which I believe it could, you look at the 50% of copper supply today is coming from countries with political instability. So you look in like Panama, for example, that just had one of the world's largest copper mines come offline and that had an material input to worldwide copper production. So I think it's also a matter of where the supply is coming from, but I think that governments may be forced to quicken the timeline of bringing a project to production stage because of the need to have copper, and also not, I think in the future, not being able to rely on getting copper from certain countries that do have that instability.
I just want to highlight to the viewers the importance of copper in our societies. Let's just thought experiment here. So suppose tomorrow all copper mines in the world shut down. There's zero copper production as of tomorrow. What happens?
Well, I think that people will quickly realize how reliant on copper that we are. It's a huge component of all of the whole electricity process. It goes into our phones, goes into all of our tech. It goes into a lot of the components that we often forget are driven by mining and copper supply. So I think if 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 we lost a material amount of that supply and the supply demand imbalance grew even more, I think that we'd have a lot of disruptions amongst um, all of the things we take for granted on a day-to-day basis.
Well, copper is already at near a multi-decade high. It peaked at around $5 in 2022, came back down, and then now it's back at above $4.40, almost 4.50. I mean, how much further could it go? What is a reasonable valuation here?
Well, I think with the demand case, you look at Citibank that sees a bullish case for copper and that going above $15,000 per ton, which equates to around $7 and or sorry, $6.75 cents per pound. So I think that in my view, I think that we are at the start of the copper price breaking out based on inflationary pressures, based on the large supply demand deficits that we see and project going into the future as early as 2030 and beyond. So I think that we could be at the start of copper rallying. And once we do break out to new all-time highs, which we're not that far from, just as we've seen recently with gold, it can move fast, and without those resistance points, who knows where it could go.
Well, I guess the obvious question for investors is why would I be involved with copper projects if a lot of them are in jurisdictions that you said are politically unstable. Let's put it that way. They may be shut down. They may be repatriated or nationalized. It's just a lot of risk, right? How would you address that?
Well, I agree with you completely. And I think mining is a very tough business, even in a tier one jurisdiction. These are not easy projects to explore and develop. So I think in my point as an investor, that's why I think that where your copper and even gold is coming from will be even more and more important as as time goes on and we see more government intervention and the importance of strategic metals like copper and gold, and I think it's an increased importance in the coming years. So as an investor myself, that's why I'm focused on tier one jurisdictions, looking at places like Canada, the US, and Australia. There's others, but those are the ones that I focus on, because really there's stripping out the political risks. Mining is a tough business, and it's not a risk that I'd like to add to my investment portfolio when there's already a lot going against you. So I think in my value case, in my investment thesis, but also in the market, I think that there'll be more of a priority on tier one jurisdictions where you do have political stability, that if you make a discovery, you build a mine, that you don't have to worry about changes coming that can take a project worth billions and decimate it overnight. So I think the need for, as I said, tier one jurisdictions is here to stay and will become even more important in the foreseeable future.
So Abitibi is based in Canada with a lot of projects. We'll talk about your projects. Would you say, though, how would you respond to the argument that perhaps there is a trade-off? Perhaps there's a reason why people go to the DRC or to South America for copper. Perhaps the grade is higher there. So you're trading a safer jurisdiction for a less high grade mine. Would that be accurate to say?
I think there's certainly in some of the as you said, in the DRC or in some of the more riskier jurisdiction, some of those are more underexplored. There's cheaper sources of labor. It leads to lower ASIC. So certainly the investment case for lower tier jurisdictions is there. Sometimes it's more profitable, because of the factors that I mentioned. But I think as well, all of those benefits can evaporate overnight if you have a government that is comes into power, or a government that changes its policy on mining, or sees new risks that it wants to mitigate. So I think in my mind, the benefit and security of operating in tier one jurisdictions outweighs, in some cases, the higher grades or more profitability that you can see in lower tier jurisdictions, because I think the need and importance for sources of these metals are increasing and significantly over the foreseeable future. So I think that it could lead to more government intervention in those places as everybody is scrambling to secure sources of these metals.
Okay, I think this might be a good time to actually talk about Abitibi itself. So give us a sense of the scale of the projects, the size of the deposits, the grade, and which phase you're in the exploration process.
Yeah, so I founded Abitibi back in 2018. We brought it public in 2020. And really, we wanted to bring myself, my family office, we wanted to bring a public a vehicle that we could get behind for this cycle. We're not perma gold and commodity bulls, and I think that a lot of times this business is either really good or really bad. So it's good to time it right. So that's why we're here. We founded Abitibi to really build our vehicle for this cycle. We've self-funded this company during a tough market downturn, which has allowed us to keep our cap structure tight, but also set up for what we believe has been a company making acquisition in acquiring the option to earn 80% of B26 in November of 2023. So B26 is a polymetallic deposit located in Quebec, Canada. So this is an asset that was owned from discovery in 1997 until the transaction that we completed in November of last year by Socom, which is a private company financed and funded by Investment Quebec. So this is a very rare opportunity that we've found, that this is a deposit of 11.4 million tons at 3% copper equivalent across inferred and indicated, that hasn't been in a public company before. So we are the first public company to showcase what is there at B26 today, but also develop and show the pipeline of growth at the project. So it's a very exciting acquisition. I think that polymetallic deposits are very rare in Canada and across the globe as a whole. So I think in this cycle, and as Pierre Lassonde has said, and Mark Bristow from Barrick, the best deposits are copper gold deposits. And we do have that with B26. We do believe that the gold historically has been quite underexplored. So that's part of our investment thesis in the B26 that we look forward to outlining further.
What do you mean when you say the best deposits are copper gold? How do you define best?
Well, I think it meets the demands of the market today. It also is some of the most profitable mines. In the case of polymetallic, some of these mines are built on the basis of some of the credits. Say, for example, if you have a gold-focused polymetallic, the mine is built and funded by the copper and zinc components, and then the gold is a bonus, and it makes the AISC of these mines a lot lower. So I think that's why, and we also see a lot of the gold mining companies now are also switching and publicly diversifying into the base metal space. So I think they realize that they're leaving opportunities on the table by not looking at base metals. And especially when you have the best of both worlds with a deposit like B26 that has a strong copper, zinc, but also complemented by a gold silver. You have the best of both worlds, and it just adds to the overall value proposition.
Okay, I'm just looking at your share price now. Year to date, it's been trading range bound, but last year, as of November 13th, 2023, it was at 13 cents a share, and then it jumped up over the next 2 weeks to 50 cents a share. What happened there?
So that was when we announced the B26 acquisition. I think that we were a small company, but what we had was we had good alignment from management as the largest owners of the company. We self-funded the company through tough market conditions, and we provided an option agreement to SOQUEM, which had what we believe is a company making acquisition with B26. And we appreciate the trust that they had to granting what was a small company at that point a very significant option. So I think what you saw there was the value arbitrage between us being a small company that we're very fortunate to secure such a strong partnership with SOQUEM, acquiring and optioning 80% of this asset, and very quickly raising $15 million in short order to take any doubters out of the market that said, okay, this asset is too big for a company of this size. Are they going to be able to finance it? Well, we quickly addressed that concern, and we did it in a very tough market with no warrants, with strong shareholders. So, but that's where you saw that large price increase through the remainder of the year.
Well, let's talk about share price performance this year. I don't mean to single your company out because the whole industry has been lagging behind gold for the most part, your stock included, right? Why is it that the bullion has been outperforming a lot of the miners? I'm not going to say all of them, but a lot of the junior miners underperformed the underlying metal. What happened here?
Well, I think you got to first look at the majors, and we're trading at $2,300 gold, and the majors on a cash flow basis are probably valued closer to 15, 1600. You look at Barrick Gold, for example, that's trading at half the price as it was in the 2020 high. So I think people are not believing that this breakout is here to stay because we're not seeing the performance in the majors. So I think we need to see the majors perform. I think the majors are set up for very large growth because they are starting to get their costs better under control. Their cash flow that they're producing now is significant. So I think we need to see money come into the majors. I think that will trickle down to the juniors, but we are seeing standout names that are pushing through market conditions. But I think the ones that are pushing through today will outperform significantly when we finally get the tailwinds behind the sector.
Are you expecting more M&A to happen now that gold's pushing to $2,400 an ounce? We're just starting to see the GDXJ and the GDX indexes push higher over the last 6 weeks or so. I'm seeing hype in the charts. Are you taking advantage of this hype? Is there going to be more M&A, you think?
I think so. I think we're at the very start of increasing M&A. I think looking at the majors, they seem to always chase. A lot of them don't want to be the first in the M&A cycle. And I think a lot of their shareholders are focused on effective capital management right now and minimizing risk in what is a very volatile economic setting that we're in today. So I think the majors like to chase. I think that if we continue to see gold and commodities break out, I think at some point we're going to see a couple transactions go through that will kick off more M&A, because at the end of the day, production profiles with the majors are falling off. There's a clear need to replenish reserves. And at the current valuations in juniors, it's much cheaper to grow through M&A and acquiring juniors in comparison to doing the exploration and development themselves. So I think it's a matter of time. We need to see a few transactions kick things off, and then we'll see FOMO amongst the majors where they're not wanting to miss out on these opportunities. Because as soon as we see some of those transactions goes through, shareholders of the majors will be bugging their boards that let's not miss out on the next one. So I think that we see a few and a few more.
But can you just explain that to the shareholders or viewers watching who may be interested in the sector but are not mining experts? Why is it that greenfield exploration for a senior is more costly than just acquiring another company? I mean, certainly the capex on the ground you put into a new drill can't be worth more than an entire company, right? What am I not getting here?
Well, I think it's a value. You have to look at the value of resources in the ground. And I think it's also a result of our sector and juniors being so unloved at the moment that it's just the valuations are so low that you look at the cost to reproduce some of these gold deposits and polymetallics and copper porphyries, and the cost to replace the investment that has been made in a lot of cases is cheaper than where the companies are trading at today. So I think this is a disconnect that is a result of basically neglect and just the space underperforming for so long, but it offers a significant opportunity for investors, in my view, and also for the majors to replenish their reserves.
Would you say that just based on the numbers you've seen, that a lot of projects in the junior mining space are trading below NAV? In other words, if you just count up the size of the deposits, all the ores in the ground that have been indicated and inferred, multiplied by current spot price, that number is higher than the current valuation of the company?
I believe so. I've seen multiple examples of that being the case. I think it's also a result of capital being very hard to raise in the space. So a lot of these companies are running out of money, and then the equity is just they're in a downward spiral where their management teams are having troubles pulling themselves out. It's not because their assets are not good. It's just because the capital available in junior mining today is still very low. But I think that circumstance is changing.
There's a common criticism I've heard from some investors, which is that they don't want to get involved in the sector because they don't know which companies are quote unquote lifestyle companies, which is to say that the management team pays themselves a big salary and doesn't really do anything productive with the capital that they raise. How would you address this concern?
Well, I think that, and as a retail investor myself, that's a concern that I have when looking at any company that I'm considering investing in. And it's really the thesis of why my family office and myself has moved out of the shadows of operating and mining privately for 20 plus years to getting into the public markets, because we were burnt by so many of these lifestyle companies. And I encourage investors to look at financial statements, look at the cash burn of these companies, because at the end of the day, what's going to create value for shareholders is putting money into the ground on sound projects that have upside through either making a discovery or growing a resource. And I think that's very important. So, for example, at Abitibi, we pride ourselves on, in comparison to our competitors, on when we get to the end of the year at 2024, I'm confident that we are going to have one of the highest percentages of every dollar raised that will go into the ground. And I think that's an important metric that your followers, investors in the space need to hold more management teams accountable on, because I think that part of the reason why the juniors are in as tough a shape as they are today is because of mismanagement of capital. So we need to see better managers of capital. That there's no guarantees in this business. We can try as hard as we can, but at the end of the day, it's about putting investors in the best position of success. And that comes down to putting dollars in the ground with well-guided and strong technical teams that are directing that investment.
How much cash is the company sitting on currently as we speak today in April, and what is your cash burn rate?
So we're sitting on roughly, I believe, as of today, is $18.5 million. So we're financed through to 2026. So really, there's no financial risk in Abitibi Metals for the next 2+ years, and that puts us in a position of strength um, amongst our competitors, that investors don't have to worry if we're going to take uh, 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 an overly dilutive financing that hinders their current position. So our burn rate is low. I'm sure that we're in the lowest decile of burn rate compared to our competitors, but I'd say our ratio that we want to maintain is 85 to 90%. So out of every dollar we raise, we want to every year put in 85 to 90 cents of that money into the ground. Well, while still having to get our story out through marketing and through G&A initiatives. But at the end of the day, every component of this, we need to get a good return on investment for our shareholders.
Okay, well, I know you just closed financing, but why wouldn't you raise another round now that there's a lot of hype with the price going up?
Well, I think to date, we've continued to do up rounds, increasing the financing levels of the capital that we're taking. So I think we're in a position of strength to consider any future financings, because we want to ensure that our existing investor base and myself and my family office as the largest investors are getting rewarded at every stage of the process. So I think to take an additional financing today would not allow us to showcase the hard work that we've done this quarter, drilling 13,500 meters, and what that means for our model and our growth profile of our deposit. So I think it's important to raise money at the right time. We raised just over 20 million over the last 5 months because our number one mandate was to take the financing risk out of our B26 option agreement. And we've done that. We're financed to earn all 80% of this option by next year. And we've taken a 7-year obligation and delivered on financing it in 5 months. So I tip my hat to my marketing, financial, and technical teams that have all come together to make that a reality. So, but in summary, we're in a position of strength to look at additional capital, but we want to make sure that all of our shareholders that have supported us to this time are recognized for the hard work that we've done, that we're taking capital at the right time.
Okay, and who are your major shareholders right now?
So we have Frank Justra, Greg Shimandi. We had Brian Sluchurchuk, which was the founder of K92 Mining. So really, the financing was done, the majority of it, with high net worth individuals. So we didn't use any investment banks. We did a lot of this financing internally. So I think this also speaks to the quality of the asset that we're developing, because in order to attract world-class investors, world-class advisory team, you need a world-class asset. And I think that that's what the potential that B26 has. But really, we have a very strong A-list shareholder base, some of which your audience would know, but I'm not able to disclose at this point. But I think over the coming months, we'll be able to bring more of those individuals out publicly.
And how much of the company do you own?
So myself personally, I own about 3 to 4%. My family office as a whole owns 30%. 20% of that is filed on SEDI. So you can see across myself and my board, you can see what we're doing with our stock, and we're in this aligned with shareholders to realize the liquidity event down the road. And we think that B26 has that potential.
Roughly, how much of the shares outstanding are owned by individual family offices or institutional investors versus retail audience?
So I think the retail audience has maybe 30%. The balance of it is really held within management, my family office, high net worth family offices, individuals, and we have a small institutional shareholder base, which a lot of it is out of Australia, that have recognized the opportunity and the disconnect between the valuations in the Australian junior mining market and our much lower valuations in the Canadian market. So it really gives us a unique shareholder base compared to our competitors.
Okay, well, we've talked about how inflation could be a concern for, all industries and investors going forward. What is this going to mean for your company in particular? What will you do to keep costs down in spite of higher inflation overall?
So I think I think the biggest pressure is in labor and in the case of Abitibi. I think that as a result of us having a poor exploration and mining market for quite a long time, we also don't have a strong pipeline of younger people that are wanting to come into mining. So we have a lot of companies that are competing for the same talent pool that is resulting in cost of labor going up significantly. So we have a strong team that we have at Abitibi that allows us to keep our costs under control. But at the same time, we hope that the upcoming, what we think will be a very strong gold and commodity bull market, will attract younger people back into the space, that we have a larger pipeline of talent that helps to support the next generation of junior mining companies. And in terms of our other costs, I think we control our drilling consumables, all of our other items, by just being very strong negotiators and treating the capital we raise like it's our own money, because largely it is. We have put a lot of our own capital into the company, but I think not enough management teams are as prudent on reviewing each part of their exploration business from start to finish to ensure that they're getting as much as they can out of the funds invested for investors.
Okay, let's finish off on your long-term plans. What's your exit strategy? Production or buyout?
So we haven't. It's no secret where we see the best exit point on the Lassonde curve is a buyout after growing a resource before a production or permitting decision. So our goal, and where we see this cycle with gold and copper, is we think that the demand for a polymetallic deposit, especially in a jurisdiction like Quebec, Canada, will be significant over the coming years. So it's, how do we show the growth potential to the market? How do we drill against it? And how do we grow our resource in order to showcase this as a next potential development to the majors, which we do believe, we do think will have interest in a project like B26. So to summarize, we're positioned alongside shareholders to try to position the company for liquidity event. We think that that's coming as M&A starts to increase and commodity prices and precious metals go up significantly, in my opinion. And there'll be a lot of capital competing for a few opportunities that has been able to push through this market condition. So I think, like in the sector as a whole, as Rick Rule says, when the gold and commodity trade turns on, it's like a flood fitting through a garden hose. And I think that there's going to be so much capital chasing like a limited pool of investable products. And that's why in tough market conditions, we're developing B26. We're fully funded to do so, but we think the factors will align to realize the liquidity event at some point down the road.
Okay. Where can we stay up to date on company developments and follow the company?
Please visit us at abitibimetals.com. I think reach out to info@abitibimetals.com. We're more than happy to meet with investors, answer any questions they have, because at the end of the day, I'm only able to do this, and I have to thank all of our investors, potential investors, because without them, we can't do what we love to do. And then that's build serious companies to address opportunities that we see in the market. So I invite investors to reach out. Any questions they have, we're more than happy to go over. And yeah, as you mentioned earlier, we're listed on the CSE under the ticker AMQ. And yeah, looking forward to getting in touch with any of your following that's interested in learning more.
Okay, excellent. Thank you very much for your time today, Jon. Speak again soon.
Yeah, appreciate you having me today, David.
And thank you for watching. Don't forget to like and subscribe.